Hey, everybody. It's Jeremy again. Welcome to the Tampa Bay Veteran Investor Show. Glad you guys are back to tune in. And today I wanted to bring on a longtime friend and listener, Amber Stout. Her and Rick have been really good friends of mine over the years and wanted to talk more about the loan environment, what we're seeing for long-term rentals, short-term rentals, stuff like that for you guys as you are refinancing, looking to buy new properties. And depending on the strategy, different lenders can work for different areas. So I want to give Amber a chance to just kind of introduce herself and tell us a little bit about what she's been up to, what kind of products and stuff that she has and what she does. And I think it's important to note that she's an active investor. So I always appreciate when people have their expertise, but also invest. I think it adds just more credibility and kind of layer of experience. But feel free to take it away, Amber.
Well, I appreciate it. And Jeremy, I so appreciate being invited to be on your podcast. It's truly an honor because you actually are who helped us get into investing. Very first property, Jeremy actually helped us underwrite the deal and look at the deal, and we felt confident enough to move forward. Owe it all
And
to
you guys still
Jeremy.
own
But
that one?
yeah, we still own it. Yeah.
Good
Yeah.
advice, maybe. You get the credit though.
Yeah, no. I mean, that property has quite a bit of equity in it. So if we didn't have such a low interest rate on it, I would be pulling out a lot more equity in that particular property. So it was a good deal. Cash flows beautifully.
Yeah. Yeah.
But I do agree with you on the investor side and then also having the lending experience. I think what makes me really unique is that I was an investor first. And so I know the right questions to ask. And I think it's really important to understand the investors' individual goals so that I can really just cater to them on the lending side.
No, it makes a lot of sense. It's like as the market kind of dictates the strategies, whether it's wholesaling or flipping or new builds, like there's kind of seasons to different strategies too, where like people just need to continuously, it's like with your tax planning. It's like you always need to kind of refresh your memory at least a few times a year or just throughout the year on the market for different things, right? Loan products or whatever else is happening so that you're just in tune if the strategy needs to change or business model needs to change it for you as an investor. You're just kind of staying educated with what your options are. What would you say is give us maybe a breakdown of different loan types that you've been doing over the last few years, or at least what you're seeing a lot of activity with right now, if it's long-term rental, short-term rental, or just your kind of breakdown of loans that you've been helping people with.
Yeah, so I've been seeing a lot of short-term rental investors lately, and think I think the reason for that is insurance costs have increasingly gone up in the area. Home costs have also gone up. So I think for the traditional investor who is maybe going after like the 2 to 4 units or the 1 to 4 units, maybe they're not cash flowing as they were in the past. Investors are really looking for cash flow. They're looking for, well, mainly higher cash flow, I would say. And so I'm seeing a lot of short term deals going on right now. And then there's some really unique products for short terms. So most commonly there's three, depending on the investors, what the investor is looking to do with that property. You could do like a second home loan if you are looking to also use it as a vacation property. You can do a conventional investment home.
Mm,
Or my favorite product for investors right now is the short term rental DSCR loan. Super cool product, uses the projected rental income from Air DNA. So we have that clarity up
okay.
front. What is the income from the property? And then as long as that covers the principal, interest, taxes, insurance, and we are good to go. We're golden. It's 20% down. I think that's a no-brainer of a product. That's what I'm seeing most
Yeah.
commonly used.
Are they and they're still looking like the borrowers kind of credentials, or is it mostly like when people say like asset based, like they're just like lending on the property? I mean, you still need like decent credit, right? And to have like somewhat of a clean kind of record, or is it kind of like, hey, as long as you got the down payment and the property looks like it's either maybe the short term rental is already operating, or maybe it's sort of like someone's going to buy it, renovate it, and do some stuff. How like strict are they also looking at the borrower? It's like almost like a traditional kind of they're gonna run through everything.
It's way simpler. So they're typically just looking at the credit, and then that there's down payment and reserves. And you can even get a little bit creative on the down payment side. Some of these lenders, and just to give a little bit of context, I work broker, so I work with a lot of different lenders. Some of these lenders will allow us to use gift funds. So a lot of times you may not even need
Hmm.
to necessarily have the down payment personally, but they do like to see reserves. So you do need to have reserves of some sort. But it's way
Okay.
simpler
Is
than
that like what? Gotcha. And reserves, is that like going to be like 3 months or 6 months of reserves plus down payment, something like that?
yeah, it's typically 6 months. 6 months
Okay.
of
Yep.
monthly payments. Yeah, they want to see in some kind of reserve account. Now, could get even more creative and take out a HELOC, and as long as it's by the time we close, as long as it's in the account, that can count as reserves.
Yeah. Okay.
So we could get super creative there, but yeah.
Are they doing any? Do they make you factor in like, hey, we know that there's going to be some sort of like maintenance, or like, hey, we know that it's not going to be 100% occupied. Are they just kind of saying, taking a percentage of the, let's say if there's 30 days in a month, are they going to look at the income for the full month and say, okay, we're going to take 90% of that and assume that's the occupancy? Like how much how much are they kind of analyzing sort of what might be more of a net number for, or are they just going off the gross? Hey, well, if you're going to self manage, we're not going to pencil in a management fee regardless because we don't know what you're going to do. It's more just is the lender just essentially looking for that gross number on some sort of occupancy rate, I guess, to
It's
qualify
a
it
great
based on
question.
what your DNA says.
Yeah, it's a great question, and it's a common question from investors. From the lending perspective, they're just looking at the gross number. Literally on Airbnb, if it's saying $100,000 in rental income, that is the amount that they are using, 100% of that. So they're not looking at it from, a true investor where from if I'm putting my investor hat on, I'm looking at it with, 10% vacancy or whatever, vacancy, et cetera. They're not looking at that. So it's very simple.
Yeah, well, that makes sense.
Nice.
It's also like one of those things I know we've talked about it before too, just like offline, where as you as the lender or us as the property manager, like you have some extra perspective to guide the client on like, hey, I know you can get approved for this loan, but let's like maybe talk to a local property manager, short term rental manager, or whatever it is, to get some extra context. Or you don't want to kill the deal, but it's also like people are going to do what they want, but you want to try to guide them like, hey, we just want to make sure you have a good experience or expectation of what the market is. And you guys may do loans all over the place, but at least if it's like somewhat local to our market and you have some extra perspective on it, you're able to guide them a little bit on like, hey, we know this is a gross number, but you should think about some of these other ones. Like you can choose how much you want to set aside for vacancy loss or, maintenance or whatever, but here's maybe some rough guidelines. Cause at the end of the day, you want to still be making somebody on the cash flow, or even if it's like a little bit of a tight deal that maybe there's some other tax benefits, but it's kind of like, I think people just need to analyze a little bit deeper, talk to, even if they plan on self-managing, property managers have good perspective. You guys have good perspective as the lenders too, because you're doing so many of these loans. You don't want 12 months down the road, the buyer to be like, oh, you helped me get this loan and property sucks. And they're like, try to blame you for their lack of analysis, on the deals.
Yeah, I totally agree with everything that you're saying. Like, I obviously would never want somebody to get into a deal where it's not cash flowing or they're overextending themselves financially. I don't think it makes sense doing it that way. And the the realtor partners that I work with that specialize in like on the investor side, they always bring in a property manager. And and a lot of times the realtor and or the property manager, if they're underwriting it, sometimes they'll kill the deal. And
Hmm.
that's fine. I'd rather that happen. I would never want somebody to
Yeah.
move forward with something that, isn't going to be a truly good investment deal. And sometimes I do find that folks do over leverage. They'll take out all of their money from retirement. I
Yeah.
don't necessarily recommend this, but I will tell them like, hey, you are overextending. There could be things that go wrong in this after you purchase. There could be,
Yeah.
HVAC or, something you need to fix something. Like you're gonna want some reserves here to make
Yeah.
sure that you can live your life, but also that you can take care of this property. And
Yeah.
so, I totally agree with everything you're saying. I think from the lending side, though, it's great having that product where, we can use 100%, get the deal done, but there is also
Yeah.
that other component of, hey, is this deal a good deal?
Yeah. That's great. And those are like 30-year products.
30-year.
And what would be like a range of interest rates that you might see? I guess if you're brokering out, you might have a couple different options, or maybe it depends on the buyer's sort of qualifications a little bit. But is that something where you're kind of seeing like 7.5 to like 9.5 on an interest rate, or is it actually pretty favorable?
No, it's super favorable. It's why it's my absolute favorite
Crazy.
product. It's amazing. So so on the DSCR products, there's something called a prepayment penalty, which I
Oh, right.
assume.
Yeah.
So for those that aren't, though, oftentimes they can go from 0 to 5 years prepayment penalty. So basically what that means, if you were to, hypothetically speaking, if you were to choose a 1 year prepayment penalty and you refinance or sell the property, you would have to pay some sort of penalty at that time if you did it within that year time frame. After that year, you're fine, you're golden. There's no issues there. I share all of that to say, if you choose a higher prepayment penalty, the trade-off is you're getting a lower interest rate. So let's say you do a three-year prepayment penalty. Now you're getting a lower interest rate for choosing that.
Gotcha.
So 3 or 2 year prepayment penalty, I'm actually seeing the rates lower than conventional investment loans.
Wow. Really? Yeah.
Yeah,
We've always liked to do like the 3-2-1, but if the cash flow is really good, like at least on the, like the pad split room rental stuff that we do, like the cash flow is so good that we'd rather just pay the higher interest rate with no prepayment. But it's like,
makes
it's
sense.
good to have that flexibility. And it's like if you're planning to hold it for a while anyways, and especially if it's performing already, you have a good idea of like potential future cash flow. I think 3-2-1 is definitely not a bad option either. So that makes sense. But those are really good because a lot of our rates on our stuff, which is, we don't have any like Airbnb style properties at the moment, but like more the room rental kind of stuff, which falls into a unique bucket. Yeah, I mean, I think most of our loans are like 9 or 10%, you know. Yeah, but the cash flow is so good it doesn't really matter. But it is like when you in context, it's like, you're like 3 or 4 points cheaper for the short term rental product, which is like a little surprising.
Yeah,
It's
it
pretty
is
awesome.
surprising. Yeah. For products on the pad split, do you guys go commercial or it's straight?
I think it's a DSCR. And if it's been maybe 2 years now since we had to do like a new loan or anything, so things might have changed a little bit. But yeah, it was just set up. I think it's DSCR, and yeah, like 20. I forget 20% down or 30% down or something. Maybe 20. But yeah, those have been good. But short term rentals, talking with like Jared over at Teal Door and those guys, it's been like there's still a good unique market for I think the right type of short term rental property. And are you underwriting those like a lot in Florida, or are you kind of doing stuff all over the Southeast? Like where are you guys mostly doing a lot of your short term loans?
It's closed three actually here. I'm also doing them around the US as well. I'm seeing actually a lot going on in the Poconos,
Mm,
Pennsylvania. I'm also seeing a lot going on in the Carolinas. And then there's some deals that are here too.
yeah. Yeah, it's always a good thing just to keep an eye out different markets too if you have experience or I always tell people like, in Tampa Bay, it could be tough to find good rental deals right now, right? Whether it's short term or long term. And if you're from a different city or you have, families in a different city, like you have some local connections, it's not a terrible idea to consider a second market for at least the time being until the market comes back and, where you live. And I think it's always best if you can just invest in the area, within an hour or something, as if you're just sort of getting your feet wet. But if there's not that opportunity, it's not a bad idea. Look in some different markets.
Yeah, I totally agree.
But yeah, those make a lot of sense. I think even like long term rental, you can do. I feel like you could self manage if you want, like whatever. But like short term rental is a totally different ballgame. It's like
Yeah, it's
we're
a whole
running a
bit.
hotel. I mean, it's about experience. It's completely different, right? So it's like I couldn't imagine everybody really trying to self manage that sort of stuff. But
Yeah,
yeah,
I just had a high school friend buy short-term rental, very first investment property ever, and he is self-managing it. I'm like, dude, we've introduced him to a couple of different property managers
Yeah.
and he's like, they sound great, but I'm gonna save the money and do it myself. I'm like,
Yeah.
dang.
Yeah.
There's so many benefits to using a property manager, whether it's long term or short term. You guys just optimize the property, right? There's less
Yeah.
turnover.
And I gotta understand, like, someone wanting to get some experience too, like, they're like, "Hey, I wanna try this for a little bit so I know, like, what expectations I should have a property manager," but it's still, like, at least on the short-term rental side, it's like, I think the revenue maximization is, like, and the pricing and the occupancy is how, like, a professional that sees it every day is going to, make you more money above their sort of cost of what they what they charge and stuff,
Yeah, I
but yeah.
agree.
I know some people that have some properties going in some of those areas. But let's switch gears a little bit to one thing that we've seen in the local market. We had an experience with an investor last year that bought a duplex, started living in it. So let's talk to some. I think it's a great way for people to get started, or even like if they have kids that are, college or something like that, buying a property, living in one unit, renting out the other. How walk us through maybe with different loan products that are available for sort of that 2 to 4 unit, where someone's going to buy it, live in one of the units, and rent out the other, and how a lender is also looking at like the debt to income on stuff like that, and sort of just some of the qualifications. I think it's a great way for people to get their feet wet. They're just starting out.
It is the best way for somebody to get started in real estate, in my opinion. I think it's also one of the best ways to scale your portfolio. And the reason being is you only need to put 3.5 to 5% down to get into a 2 to 4 unit, which is absolutely incredible. In my opinion, there's two different loan products. So there's an FHA loan and then conventional loan. So 3.5% down. It's how much you need to put down on 2 to 4 unit. And then conventional, it's going to be typically 5% down for a 2 to 4 unit. But I think one of the great benefits to also starting with a house hack is they're going to allow you to use the other units, income from those other units to help qualify. Let's hypothetically just say that your pre-approvals for 350,000 for a single family home. And let's say we're doing a pre-approval for you're looking to buy a 2 unit. We can use call it $1,000 in income from that second unit to help qualify you, and now maybe your pre-approval is up to 400,000. So you can purchase, you have more options to purchase
Yeah, it's crazy.
in terms. Yeah. It's a no-brainer. It's a
Yeah,
amazing
that's
way to get started.
yeah. I've seen a few over the
That's
last
what
few years, and it's like I'm always like so happy for the people that do it because I'm like, man, they're just like it's such a great thing. Like it's such a crazy thing to do. I mean, even if you just get into single family and rent out some of the rooms, right? But it's like if you can get a multi-unit, like the ability to add the value over time. And how long do you? So let's say somebody originates the note, or they buy the property, they move in. How long do they actually have to occupy before they could? Now I know if they're using their sort of FHA, might be a little bit different on the second time around, but and they have to go conventional. But how long are they supposed to live in the property before they might be able to like repeat that process on a different property? And I'm assuming that 3.5 FHA or the 5% is that specific for like first time home, like first time buyer, or can you do 5% down on your second one if
you
you're
can
going to
do
live in it?
5% down. You can do 5% down on the second one. So FHA, they typically, in most circumstances, you can only have one loan at a time. So hypothetically speaking, let's say you bought your first property with an FHA loan, 3.5% down duplex. Next property you're buying is a duplex. We're going to use conventional, and then you can do 5% down on that one. And then to answer your question about how long they have to live there, uh, the intent has to be 1 year. So truly the intent does need to be 1 year. But if
Yeah.
something does happen like, a job change or some unforeseen circumstances, and you need to move and you need to go buy something in 6 months somewhere else, you can do that. But the true intent does need to be
Yeah.
1 year. But
Yeah.
yeah,
I mean, 1 year
it's
goes by so quick, anyways.
yeah, goes by so quick. And I think it's a great way too for, to your point a little bit earlier, for somebody to get some property management experience,
Yeah.
figure out, how they how they want to manage tenants. I think it's a
Yep.
great learning experience. And that's how we got started. Did 3.5% down FHA loan on a duplex. Next property
Yeah.
we bought we actually used we used another FHA loan, but we did the first one in my husband's name, second one in my name. So you can also do that too.
Gotcha. Yeah. If somebody's buying just like a standard duplex and they're not going to live there, uh, is it still pretty much like, 20% down kind of loan product is essentially what you're going to have to be as like a business purpose loan or, you know, whatever it says. 20% seems to be probably the minimum, right? In that sort of circumstance,
Yeah, exactly. So if it's a true investment
pretty much.
property, 20% down. Yeah.
Yeah. Yeah. Yeah. Have you guys had any, like with the company that you work for or just like in the environment talking to other loan officers, has there been any changes to some of the loan products that you've seen in the last, let's say 12 to 18 months? And are there any talks or chatter about anything new coming down the pipeline, like any just new loan products that are being developed, probably, more specific to the investor space that you guys are seeing?
So there's definitely been talks, and you may have heard of this about 40 and 50 year.
Yeah, I forgot about those.
So there is talks about that. Definitely seeing DSCR, some creative options with DSCR. So starting to see some interest only options with that. I don't know if you've seen that before. Have you seen
Mm.
that?
No, and I don't know if that we've even specifically been asked for that either. Would that be on like so are those still 30-year where it's like, hey, maybe you get interest only for like 3, 4, 5 years? Or yeah, dive into that a little bit more because it's not been something that I've been educated on
Yeah.
somewhat recently.
Yep. So every lender will be a little bit different, but there usually is some sort of like 7 year, 5 year, 10 year of interest only. And then it will move over to fixed. I did recently have an investor close on an investment 1 year ARM product, which is pretty interesting. So it's an adjustable mortgage rate. Um, so that's another interesting one that not a lot of lenders carry. There's only one lender I know that'll do that. His intent is
Yeah.
he's in a unique situation, but wants to refinance within the first year. So we went with that product because the rate is just crazy low on something like that. So that's an
Is there any
interesting one.
interest only for like a refinance or it's only interest only on a new purchase?
It's a great question. I don't know. I haven't had
Probably on
any.
new purchase, but maybe you can, because I'm like, dang, dude, if we could refinance one for even get like a 3-year interest only, I'm thinking more specifically our pad split stuff. So like the cash flow is super high. I'm like, oh man, we could get a couple years interest only, like, or a low
Oh,
wow.
that's
But
interesting.
it's probably new purchase only, I would guess. But that's cool because I'd only really heard about interest only kind of being 5 plus, either commercial or like, yeah, 5 plus multifamily being commercial still, but like the multifamily side, that's like 5 plus of interest only. I hadn't really heard much chatter about that on anything lower than that. So it's kind of interesting.
Every lender is trying to get really creative right now and come out with some new products. So there's the conventional side of lending. So there's like, the FHA, the conventional, that's like the normal stuff you hear
Yeah.
most commonly. And then there's something called non-QM, which is like your funkier stuff. So your DSCRs, you have bank statement loans, you have 1099 loans, you have just kind of funkier loans. Every lender is now having a non-QM department. So traditionally they were conventional, typically conventional lenders, and there was just a
Yeah.
handful that did the non-QM loan products. Now every single one sees the demand for non-QM products, and so they're
Yeah.
developed departments. They have to be a little bit more competitive now too. So I think
Yeah.
we'll continue to see more loan products, more creative loan products around like DSCR and some of
Yeah.
these funkier
And
loans.
I know this year we had a couple little rate adjustments, and maybe we'll see some more in 26 probably based off just like sort of things that I'm exposed to or just chatter that I hear or podcasts, things that I listen to. But I still feel like the days of like the twos and threes and even fours are probably like I don't think that's going to be a thing for a long time. Kind of in my opinion, but I feel like we're pretty close. That five, I think between that 5 to 6 seems to me like pretty normal. Like where probably the rates are going to sort of be for a little while, but it's like if the interest rates, the taxes, insurance, it's like all that stuff is just is what it is. It's like you can't time the market, so you kind of just need to get into the market when you can. But um, what's the kind of going rates right now for just some of the products that you guys are seeing? Is it mostly whether it's non QM or QM? Is it you know 4 to 6 is kind of where most of the stuff's falling that you guys are writing?
So FHA, I'm seeing high fives, like 5.75% ish. And then conventional, I'm seeing high fives, low sixes, just depending
Okay,
on
yeah,
credit. And then
yeah.
non stuff, I'm seeing like mid sixes to high sixes, which
Yeah. That's
feels
great
great.
for non-QM, man. It's crazy. Seriously, like, but I would think that you'd be north like 7.5 on stuff like that because it's just like a little bit out of the box, or like you said, bank statement loans and stuff, or someone's got a bunch of cash, but they're like employment's super spotty. Yeah, I think I don't know if I'd like your perspective, but I feel like 2024 kind of like was just crappy for everybody. Last year was really good for us on the management side, but really, it was starting to pick up. Uh, and then, like, I just feel people are more mentally optimistic about this year. I think sellers are coming to realize like rates aren't moving super crazy. So we're either going to move and have to sell it. A good portion of our business has been homeowners deciding to rent it out after moving, like their primary. They're moving out and just renting it because they have that rate locked in. So I think everyone, at least investors, are kind of optimistic about the year about buying new opportunities or just people that have properties like, okay, if I want to sell, I just got to meet the market with where it's at. And I have seen some insurance costs fall a little bit, but
Okay.
what's your sort of sentiment personally? Then what do you kind of are thinking that how the market might be this year for you guys, underwriting loans and loan activity from last year to this year, and what are you guys kind of thinking about?
Yeah, I think we're gonna see a positive increase this year. I feel really good about it. They're also they meaning the administration's also trying to figure out how to unlock the affordability issue with housing. So they're doing that in a
Yeah,
couple of different ways. And so I feel really good about it. I think it's going to be a really strong year. I think rates right now are the best they've been in quite a while.
yeah,
And so, I'm seeing just from a pre-approval standpoint, I'm having a lot of a higher influx right now. And so I think we're just going to see overall investors and first-time home buyers and buyers just in general start to actually move, start to purchase. Yeah.
yeah, yeah. I bet you probably watch like loan app activity and all this stuff to get guided, but yeah, I mean, just like the way that technology is advancing and creating more jobs and just the demand around a lot of the data centers with AI and a bunch of stuff, like it just repurposes people. Actually, there's you know um, things that support that people actually creates more jobs. People actually make more specialized and so yeah, I just think it's a really interesting time to see not only with the tariffs and all the other things that we have going on, the tax benefits that are around for a lot of people this year that was put in with the big beautiful bill and stuff. Like there is a lot of reprieve, I think, coming to the average American people under 150K a year, or whatever, between the taxes and if you have kids, benefits with there, and 40, 50 year mortgages. To me, it's like people, if you want to own a house, like there's still no feeling like being able to own your house, even if it's like you're stretching stuff out, and yeah, maybe it's only like saving a little bit of money, but it's like you got locked in forever. It's like people are moving every whatever 5 to 10 years anyway, so it's like
The average is
they might just sell it and rent again. So it's like, who cares if it's a 40 or 50 year? Like nobody's gonna sit there for 40, 50 years anyways. If they want, they just pay it off faster. It's just like to me, it's like, why not open it up if it gives more people the option to actually get in on the ownership side and finally
start building.
own and have at least some sort of benefit versus renting if they want. And it's like nobody's gonna be there forever anyway. So like what does it really matter how long the loan is, to some extent.
It's so true. And I think the biggest mistake that we made was not getting in sooner.
Yeah.
Not buying sooner, I should say. And it's because when you buy something, over time, there's so many different benefits, whether it's cash flow, equity, tax write-offs. I mean, it just allows you to be in the game longer, and the longer you're in the game, the more financial freedom, the more wealth you're building.
Yeah. When
Yeah,
with the so on the investor loans that you guys are doing, let's say like someone's buying a duplex, they're not gonna live in it. They always have to own it in an LLC, right? Or business purpose loan or no?
they don't. They can buy it in their personal name,
Okay.
or they could do LLC.
Do LLCs, yeah. And if someone's doing like a partnership, like 2 people are putting money in together and they have an LLC, is that good enough or you still need like from an underwriting standpoint, are they asking for like, some sort of operating agreement for the LLC? What's kind of like if someone's bringing in a partner like on the deal, like let's say they found the investment property as a deal, they're going to bring in somebody else to kind of fund the down payment. Like what kind of paperwork is common to see that you guys as lenders are going to want to see to sort of qualify that as like a real partnership and everything?
Great question. So it's going to be any of like the LLC documents. So EIN and operating agreement are definitely going to be asked to see both of those.
Do they require any like if it's on the rental side, do they require you to have a property manager? Have you ever seen any loans that are like, hey, I have seen maybe it's been more commercial side where they actually want a property manager like agreement, like they want to be able to see that as part of the sort of financing that you have a professional manager in place. But I don't know if that's really a thing for the 2 to 4 unit space specifically.
It's Yeah, they don't ask for it on the 1 to 4 units, but I've heard of that on the commercial side. I mean, they definitely
Yeah,
wanna see that on the commercial side.
yeah. And the loan to value on the stuff that you're seeing is like what is it kind of like anything going up to 90% on the investor, like DSCR stuff, or it's mostly just up to like 80%?
It's typically 80%. I've seen one lender do 85%. They had a really interesting product, but
Yeah,
they have since taken it away. It was actually really fascinating. So they did 85 LTV, and then they would allow you to use, it was a DSCR loan. Usually with 85% LTV, the DSCR needs to be 1, and most commonly, it's not gonna work with 85 LTV. They would
yeah,
allow us to use assets to qualify to meet that 1. So this is a
gotcha.
super cool product, but they've since unfortunately taken that away. Um, eh, we don't have that product anymore, but to answer your question, yeah, 80 LTV. You can obviously get a little creative. You can take out a home equity line of credit and use that as the
Yeah.
down payment. Not really.
Are they looking at experience at all? Like, you know, just past deal experience doesn't really matter, right?
They definitely wanna see home ownership oftentimes. So they don't typically like first-time home buyers for DSCR products, I should say.
Yeah, like as an investor.
Yep. Yeah.
Yeah,
So they do like to see some type of home ownership initially before they're doing a DSCR.
yeah, yeah. Well, that makes sense. What's some of the stuff that you are sort of absorbing, whether it's YouTube, podcasts, like just as you as a real estate investor from an educational standpoint, like how are you staying in tune with what's kind of happening in the market? Like, is there stuff that you found that's been helpful in the last 12 months that you like to tune into to kind of get your information as like an investor here in Tampa Bay and paying attention to a lot of people that are tuning this is probably local to Tampa Bay area specifically, but whether it's meetups or who do you kind of follow to stay, in the know with what's happening just in the investment space?
So the Elite Investor Mindset Group, which you're also a part of with James Lascara, love that group. I mean, that is a group that is actively doing deals from contractors to property managers to flippers. I mean, anybody in real estate who's really doing something, I feel like is in that group. So I get a lot of information from that group, the connections in there. And then I do love the multifamily meetup that you also attend.
Yeah,
That was in Ybor, but they did just switch the locations, right?
I think it's back there. They were going to, but it's back there. Yeah, yeah, and that brings up. It's such a good point. That's how we met originally. Is like if you guys are, you got to be getting in person to local investor RIAs, or real estate investor associations, or just meetups. Like that's where so much of the magic happens, and you're able to find deals maybe off market and just connect with like investor friendly contractors or lenders. It's it's just a you have to be networking in some context to really, I think, maximize your investment journey and be educating yourself about all these different things like, asset protection, estate planning, like obviously taxes right now, sort of analyzing your tax position and understanding how rental properties play into that. Had a call with a client, rented out their like first house, and they're like, okay, like how does like some people just don't even know rental income's taxable. Like they hadn't thought about it, or like, oh, I get taxed on this. It's like, yeah, we have to tell the IRS, how much money we're collecting for you. So there's just like so much of that stuff where you got to have like a good power team of people to connect with. And that's where I think, people like us or you have enough connections where you're able to give somebody a little bit more full service kind of help, right? Like insurance companies, home inspectors, whatever it is, making sure they're doing the right due diligence on the properties that they're buying and that they have the right connections for the whole picture.
Yeah, 100%. And to your point, if I had never met you, who knows if we would have ever bought our first deal. And I
Yeah.
don't even know if I'd be sitting here with you right now. You really did like, and I say this to you from time to time, like we're just so grateful for you and your help on that first deal because it gave us the confidence to buy it and then to buy the next one
Yeah.
and the experience and all of that. So I think it's just so important to build relationships, build friendships. I mean, I've known you, I think, for almost 10-ish years.
Yeah.
Maybe a little bit less, but um, it's really important. And then you get to see what other people are doing, see what the trends
Hmm.
are. Yeah,
Yeah.
you
And
have
it's
to
like,
be.
especially with lending, we talked a little bit earlier about like strategies and stuff. Like you always need to have a plan B. Like you might underwrite a loan to do a fix and flip. Deal doesn't pan out, values fall. Like we've seen, I think in our monthly newsletter here in Tampa Bay, it's like I think Tampa's down. Last time I looked was like 8% average single family house. I think St. Pete was closer to like 10 or 11, and it was getting worse every month that I kept pulling the numbers. And of course, that's just like a broad stroke, right? But it's just like if values fall or if rents fall, you're doing performance and you're thinking this asset's going to perform better in year 2, year 3, but rents are actually stable or declining. Like you need to have backup. Like you need to know a lender that's going to have the ability to get you out of a hot spot. If you're on a 12-month fix and flip and you were planning to sell this thing, but now you got to turn it into a 30-year product, like a 30-year rental loan, you need to know that on the front end of like, if this doesn't go well, there needs to be a plan B for whatever you're doing. Or you just know that you're going to take a loss or appraisals, appraisals can come in low, right? We had a property we thought we were going to sell for like 400 and we only got like 30, 360 and because we sold it after the storms and whatever else. So you just kind of took a bath on something that should have been a pretty easy little base hit type of deal. It's another reason why you just need to be in tune with a good lender that has some different options for you because not everything goes as planned.
It's so true. I think it's important having different exit strategies. And I just spoke with someone, to your point, that is planning on doing a fix and flip, but he spoke to me on the front end. He's just under contract. He didn't even buy it yet. And he's like, "Hey, I'm planning on selling this property, but in the event that I can't sell it for what I need to sell it for, let's talk about doing a refinance and what that would look like, so that I'm
Yeah.
for both sides." So I think that's really smart.
When you guys are doing the short-term rental loans or even just like DSCR, can somebody finance like renovation costs or is it just you guys are mostly offering just financing on like the price of the property?
Just the price of the property itself.
Just
I
price.
just had a client actually who he took out a home equity line of credit on his personal home, and then he used that as the down payment, the renovations, and the furnishings. And then we did a DSCR loan on top of that. And then he's booked out for
Gotcha.
several months actually. He just got done with the renovations and the furnishings. And he's going to be using all of the cash flow to then pay that HELOC back.
Yeah, that's a great thing you bringing up the HELOC stuff. Obviously, a lot of companies will do HELOCs for your primary. There's a few people that can do HELOCs on investment, which is a little hard, actually much harder to find. But it's just like you always need to have access to capital. So like when the market's good, like when I don't need it, I ask for credit card increases on everything, right? Like it's you never know what's going to happen. Uh, but you don't always have to think that you have to have the cash in the bank, or if you have a good asset that you bought with a low interest rate and you don't want to sell it, there still could be opportunity that there's some cash in there that you could tap into to either use as a down payment on something else, or like you said, just to fund the renovation cost. if someone's doing a fix and flip, a lot of the companies will finance renovation costs there, but it just looks better if you're able to do it more on your own and not have to finance so much. The access to capital and then constantly like analyzing the opportunity cost of your investments is important. If you have 200 grand of equity locked in this property and it's like barely making a couple $100 a month, it's like, okay, could I sell that, pay the tax, and buy something else that's better performing? There's always that constant analysis that people need to be doing, but you can never have too much cash available or at least access to cash. So it's something that I think is really important for investors to always be. And everyone's like risk profile is different too with the returns that they're looking for, right? So it's like, I do a little bit of crypto, I do a little bit of stock, a little bit of gold and silver. And, if you're like looking at the difference between rental property or maybe just putting, something in mutual funds for a little bit, like real estate, rental properties, flips, things could go south and kill the cash flow for an entire year. So if you can make 4 or 5 at the bank, buying a rental property and you're only going to make like 7, plus you have all this risk of the tenant paying or not paying or vacancy loss or maintenance. And it's like, yeah, maybe you should have some extra tax benefits, but, you know, and you just want to be really thoughtful about that because not everything is, because it's planned with real estate or tenants that you have, or even on a flip, like you said, like values come in low or something. Just got to have a backup plan, but just making sure that the risk is worth the reward. And I think some investors will get caught also like investing in sort of lower income areas where the returns look better because the prices are lower. And you just can experience a lot of different types of problems in some of those areas or deferred maintenance on properties where it's just like, oh, this 10 cap looked great on paper, but then it's like, tenant left 2 months into the lease because there was a shooting on the street outside. Like that happened to us a few years ago. And it's like, oh yeah, this owner thinks they're going to have a great return. And so you just got to be thoughtful, consider where you're putting your money. And, just one bad deal can, just blow apart so much time that you've spent saving money or, because you've been at some of these RIAs, you'll see people, they'll do one bad deal, you never see them again. And, maybe they invest later, who knows? But it's like, I'm always, I don't know, I think on the conservative side of like, you just got to educate and be very thoughtful about what you're doing and assume that, rents aren't going to go up forever. Values aren't going to keep going up forever. And you just want to be careful and make sure that the return that you're looking for is really worth the, potential risk. You have the right time horizon for the deal too. How long you're going to hold it if it's a rental or whatever. But and it's like, you know, you don't have to grow to hundreds of units under your ownership. Some people would prefer just to, and probably would be better off just buying 5 to 10 houses and paying off all the mortgages. And, they're going to, and so, even when people are refinancing, you, you don't have to max out the leverage. When you're buying properties, you could just, say, hey, instead of 20% down, I'm going to put down 30 or 40. I just want to have a little bit more protection if rents go down, that my debt service is lower. So yeah, it's just everyone's different, right, on what they're looking for. But over the long term, like you said, you just can't lose for the most part holding real estate long term. Like my old primary in Ybor, it's like, well, rents have actually come down. If that same property went vacant, I'd probably lose like 200 to $300 on the new tenant from where my current tenants are. And so I'm just happy that they're like covering it. I think right now I'm losing like maybe $100 a month from taxes and insurance increases. But just like you said, it's like we used to live there. It's in a great spot, long term, like 5 minutes from like gas works and Armature and all this stuff. Um, and yeah, it's just like, well, yeah, I have some equity locked into it. I do have it on the market for sale just to see if someone's willing to sort of pay what I want. And so I'm not overly motivated for it, but just to kind of see what the market's doing. But it's like you still get the tax benefits and, have potentially up to like 150 grand equity if we do some other smaller repairs on it from when we bought it. And, you know, maybe what it was 2018 when we bought that and we moved out of there a few years ago. So, like you said, you just kind of buy at that time, with rates and stuff and the prices, like I just paid I ended up paying just the same price on the MLS, like the list price. So I didn't like negotiate. But it's like once you look back, you're like, man, at the time it felt like the price was high, right? Or maybe like, should have negotiated more. But that's what everyone says. Like my clients had all these multifamily properties, like they bought out like a 4.5 cap like 5 years ago. It's like 4.5 caps, like insane. Like who's buying like these are crazy prices. And it's like now these are the best properties that they've held. Yeah, it's just perspective, that long term look on the rental plays, It's just like build wealth slowly over time, especially in an area where we are, where we generally have good appreciation over time compared to like, somewhere in a different state where it's more like just flat, you really can't lose. So it's good. There was something else I was gonna say. I lost my train of thought. That was good. But yeah, and like you said, just along that journey, you're able to pull capital out as you go, along the way anyways. So but yeah, it was oh yeah, this was it, appraisers. So I wanted to touch on because if you're gonna refinance like a rental or something, like appraisers are I don't think get used enough on the types of like repairs you're gonna be doing to a property. But more specifically, if it's a 3 bedroom, 1 bath, and you're gonna add a second bathroom, or it's a carport and you're thinking about making it a 1 car garage, like appraisers should be used, I think, more often, or just getting their input if pay them or just somebody to also identify how you might be able to get the most value out of the property, whether it's going to be a rental or a flip, so that when you do have to refinance it in a year or you're just like trying to build value, the best thing is adding bedrooms and bathrooms, but even garages, like what's a 1 car garage worth on, an appraiser, or a 2 car garage or a shed in the back? Does that add any value? So there's kind of like this complete picture of the lender side of it, like an appraiser or broker giving some perspective. You just mentioned like not wanting to over improve for the area. And it's like right now on the long term rental side, you're seeing people have to put money in to renovate just to keep rents the same or to keep rents from not falling. Like you're not even getting the increase. Like you're just trying to do it to keep tenants there and happy. It's on the long term rental side, it's definitely tough, but that's where when you have this sort of power team dynamic, you're able to get a bit better perspective on how to increase value, and even using like someone with a design experience to help you understand like not over improving, but also like what are people looking for if it's a new build or a flip, right? Like what's actually trending, what's sort of out of style. And then on the long term rental stuff, really short term rental, it's like how do we create the experience? Like I had one of my clients the other day want to look at doing long term short term rental on their property. It's like it's just not the right sort of area. You'd have to dump an insane amount of money into the property. And so it's just like but if you're gonna do that, create the experience, you just need to know all this stuff on the front end. Like just kind of go back to before you even buy the property or you're during due diligence, like you really gotta be looking at every single angle to make sure it's gonna be successful, especially in today's market where it's much more challenging. You can't rely on rent growth to make the deal work, or appreciation is not just shooting through the roof like it was at some point year over year over year. You gotta be just very careful right now. Yeah, rules, regulations, landlord friendly areas, all this stuff matters for sure. But well, it's been a good chat, Amber. Well, I appreciate your time. Maybe I'll see you in a few weeks at the next meetup, and would love to have you on again. Sure, appreciate it. Thanks, Amber.